Hey guys, thank you for stopping by. Today I talked to Luke. Luke has been a professional investor for over 2 decades. He's been very successful and consistent in his investment performance. Actually, he retired off his investment incomes. Luke and I talk about his portfolio strategy, his big wins, his mistakes, and what are the key learnings from those mistakes, his holdings, Rocket Lab and ASTS. Also, we get his perspective on how to retire fast on investment income. Hope you enjoy the content. Please do follow my channel for such meaningful discussions. Hey, Luke, thank you so much for giving time. Your track record speaks for itself. So, tell us a little bit about your investing journey. How did you start on it, and what's your how do you feel about the whole thing?
Hi, Rajiv, and thank you for having me on the show. It's a real pleasure to connect properly. I know we've been chatting on Twitter for a couple of years now.
Yeah.
I'm a professional investor. I retired from a 25-year career with one of the world's biggest banks in 2021. Um, but I've been an investor. I may have been working for the bank. My passion was investing. So building my own portfolio in a tax efficient manner. Um, and investing in growth companies. My kind of framework and what really drives me as an investor is finding the companies that are making the world a better place through technology and innovation, and essentially trying to find those companies that I feel are providing products and services that the world will need more of in 10 years' time. And that served me really well because it means I've been super early to companies like Netflix, Intuitive Surgical, Alphabet, Amazon, and Shopify. These companies have been like mainstays of my portfolio over the decades. And in 2021, they allowed me to retire from the humdrum of office work, and now I manage the portfolio full time, but also have adventures. And I have my own podcast with a good buddy, Christoph, Wall
Yeah,
Street
I've
Wildlife,
seen.
and
Yeah.
we just have a hell of a lot of fun being investors, but also trying to make this really what can be quite a complicated world, trying to make it simple, easy to understand, and less scary.
Your returns are like over 20% CAGR. I mean, that's like that's killer, that's killing. You're beating Nasdaq.
Yeah, I try to be humble, but yes, my results are very good, and they're relatively consistent. So I've had years where I've failed to beat the market. My benchmark is the S&P, but
Yeah.
yes, you're right. Like the Nasdaq has outperformed the S&P over a long period. I've outperformed the Nasdaq over a long period. So my compound annual growth is about 22.5% over, I say 21 years, it'll actually be 22 years next month because that's my birthday of my portfolio.
Nice, nice. But 22.5% means obviously you're doubling money every 4 years. That's a lot.
Pretty much. Yeah. Yeah.
That's a
Yeah.
lot. Tell me, how do you do it? Like, what do you like? How do you construct I've seen your portfolio, by the way, and I'm intrigued why it is like that. I think your intuitive surgical is very high, then Rocket Lab is very high, but then you have 2-3% long, and I'm sure the capital is employed is pretty significant. It shows that that's why you're kind of managing things. How do you go about doing it?
Yeah. There's an overriding ethos. And if you're listening to the podcast and you want to check out my portfolio, I publish like my percentage allocations and my most recent
Yeah.
trades, buys, sells, trims, ads. I publish those to X. It's the best place to find me.
Yeah,
So go
yeah,
check
yeah.
me
That's
out
where I
on.
saw everything. Yeah.
Um, and so I've got a couple of guidelines, right? And
Yeah.
I've learned these lessons
Bring them
through
on. Yeah.
mistake the hard
Yeah.
way.
Bring them on. Yeah.
So I try and have a well diversified portfolio, but essentially, I'm a I'm a bit of a geek, and I really like technology and innovation, and like the Star Trek side of technology, like these fantastic companies that are creating really amazing capabilities. And so I'm just attracted to those companies. It means I'm very heavily exposed to technology, and I guess it also means I'm very heavily exposed to North America because that's where all the really exciting stuff happens.
True.
But notwithstanding that, within that world, I try and be diversified. So my hard rules, probably my biggest no-no, I'll never let any position get above a 20% allocation. And I've run into that twice in my career with Netflix in the early 2010s. I had to just keep trimming it to keep it below 20%. And Shopify in the late 2010s, the same thing, had to keep trimming it.
Mm.
And I might be in danger of running into that with Rocket Lab. And I know we're going to talk about Rocket Lab at some length today. So that's one of my hard rules. Like, no matter how my conviction is, nothing above 20%.
Okay.
And my other rule is I love to add into strength. So if I think about like the trajectory of when I buy a position,
Mm.
I actually I do deep, consistent due diligence on everything I own. But when I start a position, like we'll talk about another company I've bought fairly recently, ASTS Space Mobile. Um, when I start a position, actually, I do fairly light due diligence, might be the order of a few hours, if the numbers basically make sense. And I'll buy like a 0.5% to a 1% allocation in my portfolio. And then I'll just try and watch the company for a couple of quarters because I've got skin in the game. I'm motivated because I actually have a stake. I'm motivated to do the real work and listen to the earnings calls. By the way, it's fantastic to listen to an earnings call, not just read the transcript. You get so much out of the nuance of the conversation between the leadership team and the analysts. I can do some ancillary research. Maybe I find other analysts covering the stock. Maybe I can find a podcast interview with founders or leadership team members to try and understand the company. And if I still really like it, and if I still feel it's a robust investment, and by this time I've done much more work on the financials and really try to understand them in a better way, um, then I'll add. And I love to add into strength. So
Mm.
Rocket Lab, I've added to 5 times. And that company has continued to progress. I just try to add a little bit of money every couple of quarters if they're continuing to execute against my thesis. But my other hard rule is, which I actually broke for the first time a few months ago with Alphabet, I won't add new money above a 6% allocation.
Okay.
Somewhat arbitrary number, but I try to, if a company is more than 6% in my portfolio, typically it got there the hard way by growing into that allocation. Um, and then the other thing is really, just own the world's greatest companies and then hold them for a long time. So let them run. Like I try to avoid trimming, but I do these days, I trim on valuation. For example, I've reduced my exposure to CrowdStrike, the cybersecurity leader. Like I very much believe in the company, fantastic company, but the
Mm.
valuation doesn't really make sense to me today. So I'm just trimming that and trying to keep it to 2 or 3% allocation. Conversely, when stocks feel cheap, that's a time to kind of extend my exposure. So, you've been an investor for many years and you'll have invested through 2020, 21,
Mm.
2022. For me, actually, 2020 was an incredible year, but probably my best annual return, nearly 100% return that year, because I positioned quite well for the pandemic. But 2021 wasn't a great year, and 2022 was a very bad year for me. And actually, excitingly, I just retired from my full-time job in November 2021. And then literally over the subsequent 6 months, my portfolio took a 38% drawdown. So I was like, what have I done? Have I made a terrible mistake? But all growth investors, if you're in those kind of companies, that was just a
Normal.
difficult
It's
time,
normal.
very difficult time. So I use that time, instead of panicking, I use that time to refocus on my due diligence,
Good job.
understand these companies, and start adding cash, coming out of cash and back into investing. And um, I got down from, like, at the moment my cash allocation is quite high, maybe 17%. I got my cash allocation as low as 5% at that point because I'd reinvested a lot of money I had on the sidelines
Mm.
because valuations felt quite bubbly in 2021. And so, adding pretty reasonable value points, I'm now seeing the benefit of that. So, yeah, in a nutshell, like that's kind of how I navigate my
Yeah,
investing
no,
portfolio.
it sounds good. I think what intrigues me is that for the growth investor, and look, my experience is far lesser than yours, but I like the word growth anyway, in any type of, any facet of life, whether it is job, or business. I like the word growth. I don't know why. Personal growth. So growth is the word which I'm kind of very engaged with. Now, how do you find things early? That is, and and sometimes these companies, and we'll talk about specifics of ASTS and Rocket Lab. These they kind of defy all the traditional matrices. And look, how do you find? Let's talk about Netflix. If
Sure.
how
Yeah.
do you
Yeah.
find that early? And because it was not a model which anybody thought of would work.
That's actually a really great example because I became a Netflix shareholder, I think around 2007, that's that kind of time, 2008. And it was just as uh, Reed Hastings was pivoting the company from DVDs by mail to an online service and streaming. And um, it just seemed correct to me. It's like at the time, most people didn't have a very high bandwidth upload and download. So technologically, it was going to be quite challenging. But clearly, these were things we were going to solve as society. And we didn't have Netflix in the UK, but there was an equivalent service called, I think, Love Film. So I
Oh,
love movies, and we used to get like a couple of DVDs delivered by mail to my apartment, and then we'd watch those, and then we'd send them back. The
mhm.
Netflix the Netflix model prior to the streaming model, and that was great. Like I love that. I got to watch all these movies, and I just had a monthly subscription. But I thought, what if I could download these movies and I could just literally watch something on demand? It made sense that this is a service that people would want more of. So I loaded up on Netflix, and I believe I added to it. They had a bit of a debacle with something called Quickster, where they tried to like spin out a different brand, and they're almost going to like reinvigorate the mail business model. The stock took a bit of a pummeling, and I used that as opportunities to add to my position. Yeah, and then that became like the great problem to have in a portfolio in the early 2010s when suddenly I had a massive exposure to Netflix and was thinking I need to start diversifying.
Okay. No, but so how did you keep on with it? I mean, growth investing is a journey, right? It's a journey up, down, up, down. So you were intrigued by the product because it's
But
addressing certain pain and you went into that. But how did you kind of kept yourself abreast of everything? Like you looked at the numbers very regularly and how it built confidence? How did you scale it up?
so I have a thesis for all the companies I own. Um, and that thesis might have components of narrative, like the story and the things I expect them to do, but it will also have aspects of numbers, particular, say, growth rates or expansion, and gaining market share. So my thesis will be quite different for every company. Clearly, it's bespoke to the company, and I try and track against the thesis. So um, like one discipline I really am rigorous about whenever I make any trade, and I trade fairly infrequently. Whenever I do any trade, I write down a couple of sentences, my rationale, why am I buying this, why am I selling this, adding, trimming, and that's good in two ways. The first one is it makes you really be conscious about why you're doing that thing. So if you don't have a strong thesis and you're adding, or it's like a weak, you're adding, I'm adding because the stock is down. Like
Mm,
that's not really a rationale to add. But if the valuation is improved and you believe like there's going to be an inflection, for example, a company C Limited, which I own for
mm,
some time, close to your home market,
mm,
and at one point I'd lost the largest dollar amount I'd ever lost on any company because I bought into that company at the absolute peak pretty much. Um, but I could see how the company was pivoting, and I could see how they were withdrawing from their over expansion into Latin America and into Europe,
mm.
and some mistakes they made in India. And they were really trying to focus on their home markets. And it made sense to me. So, valuation down and like a lot of difficulty ahead. But I could see how the founder, Forrest Lee, I believe, was trying to like really refocus. And so that made sense. And so that was an opportunity to add to that company. My initial position is still underwater, but that add is now a double. So it is about at each point, be conscious of why you're taking an action. And I
Mhm.
did say there's two reasons why it's useful to do that. The other one is I try and be diligent every year. I do a retrospective and I look back at all of my trades in the past, but particularly the prior year. And I
Mm,
just try and judge my own decisions. And I try and be ruthless with this. So it's not a win for me if I buy something and it goes up. Like, okay, great, I made some money. But actually, the more important thing to me is was my decision the right decision at the time? Like, did my thesis make sense? Um, so I try and focus on making good quality decisions, And eventually, like the results will follow at some point.
Yeah, nice. Now, I think the talk about your mistake, one of your mistakes, which kind of scarred you, and but you bounced back from there, you know. Talk about one of your investing mistakes.
Sure. I mean, well, that first allocation to C Limited was certainly a mistake. I've been watching the company for a long time, and for kind of complicated tax reasons, I wasn't able to take a position. And I
Mm,
think my error, I started a new type of portfolio linked to my pension, and that gave me slightly different tax constraints. And I was able to buy Southeast Asian stocks and ADRs. Essentially, I bought the New York listed ADR. I couldn't buy that in my main investment account. So suddenly I was excited. Oh, I've been watching this company for years. I can now buy it. And I over allocated straight away. I bought a full 6% position. And if I follow my process, I would have bought maybe a 2% position at the most, then studied it in a different way through the eyes of an owner, which is quite different to watching from the sidelines. And I would have given myself 6 months, maybe, 2 quarters, and then added more and added more. Instead, I did the full 6% allocation. And literally within 4 or 5 months of that first buy, the stock was like halved in value or worse, because that was really when they felt the real pain of their overexpansion. And so that was a pretty big error.
okay. Yeah, I think, yeah, getting excited and breaking your own rules. We are the enemies of ourselves, you know. I think controlling ourselves is most important. How do you manage, Luke, this consistent performance? How do you like what do you do? Is it like you just there are guidelines you have which you keep following again and again, and the consistent performance is an outcome of that. But it's really consistent over such a 2 decades, you know. How do you ensure that?
It's not so consistent. I'll give you an example. 2022, I
Mm,
say 2021, 2022, they were pretty bad years for me. So 2022, my portfolio delivered a negative 38% return. But actually, if I look at myself against the benchmark of the S&P, in 2021, I underperformed by 23%. And then the next year, I underperformed by 28%.
mm.
So, compounding poor performance really negatively impacted my portfolio. But again, it was just instructive to focus on the companies, not the stocks, really take a long game view. And I've had moments like this probably over the last 22 years, maybe around 2011, 2012. I underperformed the index by a few percent. 2016, I kind of delivered a market performance, but that was a very good year for the S&P. But overall, I'm beating the market. Well, I'm not beating the market by 22%, but overall, I'm delivering a 22% return versus the S&P's return of about 11% over the same period. And it is just about being. It's the things we've talked about. If I said there's one thing to do, it's ignore stock prices. They're an output. Focus on company performance. That's like the input, and the stock price is what comes out at the end of the market digesting what the company is doing.
And when you look at the company's performance, which are the matrices more important to you?
Probably the one thing that is consistently important to almost every company I own is revenue growth,
Okay.
which tends to correlate highly with, like, I think McKinsey or somebody years ago identified revenue growth as being like the key metric that drove investment performance. But different companies will be quite nuanced. I'm quite a fan. I don't know if you use fiscal.ai
I use that.
previously.
I've started using it.
It's a fantastic tool, and they do a really good job of identifying what they call like segment data. So, as well as pulling out the standard metrics that you would see on like a income statement, balance sheet,
Mm.
the cash flow statement, they also pull out numbers from the narrative. And every company, so we're going to talk about, say, Rocket Lab today. So, a useful metric to look at with Rocket Lab is they launch things. We'll talk about it in more detail, but they also have a space systems segment. And it's interesting to see how the inflection point of the company went from being mostly about launch to the revenue now today now mostly being about space systems. And Fiscal AI do a really good job of pulling that data out, and then you can start to use it as data rather than having to read, the last 10 quarterly reports and then create your own spreadsheet. So every company has its own unique data points. I used to have to work this out by hand. Now, to be honest, I largely rely on fiscal.ai's data because it's very good. And they've typically picked the most important segment data that I was finding I was picking myself anyway.
Yeah, I think most of the growth investors I have talked to, and including me, I think the revenue growth is the key figure. I mean, that's a good starting point because if you're growing over 20%, 22%, you're doing something really, really good,
Yeah,
And
yeah.
I mean, the Meta results came out, I think they're showing about 23% growth or something, which is on the size they are, 23% is like, it's a God performance, it's God mode.
Are you
Rocket,
invested in Meta yourself, Rajiv?
yeah, I am. I am. I'm pretty happy yesterday, and I bought a few shares before the earnings.
Hmm, great. Very
So
good.
I'm
Yeah,
happy,
I heard
and
earnings were
yeah,
gangbusters
yeah,
yesterday.
and I bought a few shares of Google also before earning. Like Alphabet is a new addition for you as well, and I think I'm kind of counting on the misunderstanding of market about Google that they've lost the battle on search, and it's undervalued among all Mag 7 is the most undervalued company. So I'm kind of counting on that. I don't know what's your thesis on that though, but
I highly support exactly what you just said. I've been an Alphabet shareholder since 2010.
yeah,
It's the one company I broke my rule with, and I added new money above a 6% allocation for precisely the reasons you said. It's the cheapest of all of the Magnificent Seven right now. The market fundamentally misunderstands the
yeah,
impact that AI is going to have on the company. The market seems to believe that AI is going to disintermediate Google search.
yeah.
And actually, I could talk for 10 minutes on this topic. I know we weren't set up to talk about it, but there are very, very good reasons to believe that AI is going to be a huge tailwind for Alphabet and propel them to higher revenues, not lower.
Yeah, I think for me, the Google thesis is I spend so much of time on YouTube, and I
Yeah.
think who has YouTube? Nobody. Is YouTube can be replaced? It can't be. Search can be replaced. That's fine, but they are doing other things to compensate for search. It's like they're just sitting. They're not sitting on their bottom and not doing anything about it. They're
Yeah.
slow. They're big. They're slow. They're not as fast as Meta because Meta is run by a founder.
Mhm.
But I think they deserve more respect than what they're getting right now.
Yeah. Well, Alphabet's almost run by a founder because Sergey Brin has just come back to the office and now he's
Why is
like
he?
in meetings and leading like design sessions and coding. So
Okay,
yeah, he's back in the game. Yeah.
that's amazing. Let's talk
Yeah.
about Rocket Lab. I was quite, it's not a big company, right? I mean, it's not a very big company, and you put about 10% of your money there. I don't know, you may have put 6%, it may have grown to 10%. That's a different thing. Or now you're saying 20% or something. When I looked at it, it was not 20%. So what does the company do? I mean, that's the first thing.
Yeah. Okay. Well, I mean, let me tell you about like how I navigated it, and then we'll
Yeah.
talk about the company. I'm happy to go deep on this one. So, this is like really close to my heart, by the way, because I buy an investment gift for many of my friends' children and also other children in the family. And I bought Rocket Lab for them in December 2023 and again in December 2024. That
Mm,
was the level of my conviction. I was willing to put my reputation as Uncle Luke on the line with this one.
mm,
Um, so in my own portfolio, I've bought this 5 times, and
mm,
I've only really actually, in terms of my own money, I've bought probably a 2.5% allocation, and today it's about a 14% allocation. So the stock has been on an incredible run, and let's kind of unpack why and kind of what we think about it today. So first of all, very high level, who are Rocket Lab? So it's an end-to-end space company. They provide launch services, they make satellites, and then they put the satellites in orbit and then they operate them. And so it's kind of the whole shebang.
mm,
If you want to have some kind of communication or monitoring satellite, Rocket Lab can do it all for you. It's got customers in the defense sector, in government, and also commercial markets. So again, it's kind of touching all
mm,
segments.
mm,
It's actually the leader in small satellite launch.
mm,
So we'll all be familiar with SpaceX and SpaceX's Falcon 9. That's considered medium launch. Um, in small launch, Rocket Lab are very cost competitive
Okay.
And the benefit, say you're a smaller customer and you want to put something into orbit with a Falcon 9 with SpaceX, well, you either have to spend a lot of money and buy the entire payload if you want to go to a specific orbit, like a specific location. Maybe you want to put like a satellite that monitors
Mm.
like a certain part of the world, so it'll go kind of pass over that every many hours. So if you go to SpaceX, you have to spend a lot of money because it's a lot of capacity. If you go to Rocket Lab, you're buying much smaller capacity, up to about 300 kilograms, and
Mm.
then you could buy that whole capacity and you can put your payload into a very specific orbit for
Mm.
your needs. So it's much more cost effective for smaller customers.
Okay.
Right. They've had an incredible track record. So they've now completed 64 successful launches and only four failures. So out of 68 attempts, 64 were successful. Like the first one failed, but since then, only three other failures. And that's almost unheard of in the space industry.
Mm.
Um, like space is difficult, it's expensive. I think there was a launch failure in Australia just a few days ago that kind of draws a line under this. It's
Mm.
very hard, but Rocket Lab seem to be making it easy. And if
Mm.
we talked about revenue growth, like
Mm.
if we just look at the trajectory of their business
Mhm.
in 2024, they had 16 launches, and now year to date they've had 10 launches. So they're on track for 20 plus launches this year. So that's like nice growth. And even if you look at say 2024 full year, that was 60% year over year growth in terms of number of launches from 2023. So nice steady growth in like demand and supply. There's plenty of demand out there.
Okay.
We'll come on to why the stock valuation is where it is, but to sort of touch on the main reason for that, it's something called Neutron. So they are trying to get into the medium lift category to be more competitive with Falcon 9 because it opens up the market for them, lets them move up the value chain, compete with like the larger aerospace players like SpaceX. So they've got their program of Neutron coming with a test flight planned for second half of this year. Like market's somewhat skeptical whether they'll hit that date, but certainly first attempt with their medium lift rocket is going to be a very volatile time for shareholders. So like something to watch out for. They've able to pivot their technology not just into putting stuff into orbit. They've also got something called a HASTE program. So essentially, they're using their Electron rocket, but to put payloads into like a hypersonic speeds within below orbit. So it's like really reading between the lines. That's like hypersonic missiles and defense systems like that, which there's, the situation in the Middle East and the situation in Russia, Ukraine, like governments are looking for alternative technologies to like essentially sort of expand their strike capability very, very quickly. And hypersonic missiles are one of the answers to that. So Rocket Lab's HASTE program, there's plenty of demand for that. Whether you believe in and support kind of military action or not, the customer has demand for those kind of services. And there's a whole bunch of other exciting things they're doing. Maybe one just to touch on before we look at the numbers is their Venus Life Finder program. So they're planning next year, next summer, to be the first private company to try and put a payload into orbit around Venus and then start the sampling like Venus's atmosphere. That's quite exciting. Like governments have done that before, but the first private company to do that. So that's kind of an exciting science moment. So we mentioned when we were talking about fiscal AI, there's the launch segment and also space system segment. So launch is very exciting. That's like seeing rockets go up and hopefully
Mm.
not crashing. Space systems is really where the money is. If you're an investor, that's the bit that keeps you excited. That's where they manufacture satellites. They have their own bespoke payload called Photon. So kind of like a cookie cutter style satellite that other customers can attach their own like sensors and instrumentation to, or they can build a satellite with the components that they manufacture. They're very vertically integrated for customers to really achieve any kind of
Mm.
objective. And so space systems today, I think over the last 12 months, generated $338 million, whereas launch was just $128 million. So it's kind of $500 million in revenue, but almost 2/3 of that is space systems. So that's really where the money is as a Rocket Lab investor. So I really like this company, and hopefully you can see my enthusiasm for it. But right now, I do not like this stock.
Yeah, it's
Right?
very expensive, isn't it?
Yeah. Like the opportunity is massive. The space economy is reckoned to be a $500 billion industry last year,
Mm,
and it's expected to reach $1 trillion over the next 10 years. Maybe some banks have even said like $3 trillion. So the market opportunity is enormous because Rocket Lab have only got like $500 million market share. So plenty of room to growth. And they are growing well. Like if we look at some of the positive financials, I always said, like focus on the fundamentals of the company, not the stock. Like revenue is growing really well. Seven times revenue growth over the last 3 years.
mm,
Gross profit is growing really well. Now it's $116 million a year, up 126% year over year. So the
mm,
company's got a good model. They're still making an operating loss because they're like a young space company and they're investing in their Neutron program. But the operating loss is, there's good reasons for why they're generating that operating loss as they scale out. And also really well funded. They've got cash reserves of about $270 million, a current ratio of 2.1. So that's like they have twice
mm,
as much, essentially, like money they can get their hands on to cover their debt. Um, and they've got quite a big backlog, over $1 billion of booked work that they have to fulfill over the next few years. So they're like, if you look at just those numbers, they're really robust. They're well set up. They're operating in a prudent manner. They're getting ready for Neutron. But if you look at the valuation,
mm.
this is where the wheels come off a little bit. Like I'm happy because the valuation has gone crazy. I look like incredible Uncle Luke who's delivered, a multi-bagger return for my
Mm.
friends' kids and in my own portfolio, frankly, as well. But if you look at the valuation, it doesn't make sense. And it's because investors, like it's almost become a meme stock on forums like Wall Street Bets, right? Everyone's excited about Rocket Lab, and they're really excited about Neutron, which is this medium lift,
Mm,
which is hopefully going to happen this year, first test flight.
mm.
But the valuation now is, if we look at it on say a price to gross profit basis, it used to trade in a range of sort of 30 times gross profit. It's now 165 times gross profit. So the
That,
market has really bid it up beyond all kind of reasonable points. When I was buying this company, it was a $2 or $3 billion company. Now it's a $21 billion company.
wow.
So that's like
Incredible.
it's got a little bit out of hand. And it's because everyone's so focused and excited about Neutron, they've lost sight of the fact that actually what this company is about is space systems and manufacturing satellites. And so the fever and the excitement has taken hold around this company. So I think the very best possible outcome is they're successful with Neutron later this year. And if they are, probably that success is already baked into the valuation.
Yeah.
If they fail with Neutron, which frankly is likely, like space is hard, the valuation is going to get decimated. And if they fail with like the second and the third Neutron attempt, they're capitalized for that. They've got enough money to make many attempts.
Mhm.
But if they have a succession of failures, which is not out of the question, the stock is going to get crushed. So I would say if you don't own any Rocket Lab, I would buy some today if I was not an owner. A small allocation just to get a foot in the door, motivate myself to start doing the research and understand the company. Do your own due diligence. Don't listen to guys like me. Figure it out for yourself. But if you have a relatively substantial allocation, you probably now, if you're prudent, you want to start thinking about trimming that and managing your exposure.
Yeah, I kind of agree with that. And but you have another company, ASTS, which is hitting through the roof, which is hitting through the sky. Like it's like talking to God now.
Is that ASTS you're referring to?
Yes, 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 yes.
Yeah, ASTS Space Mobile. So this is a new allocation in my own portfolio. So I'm at that stage where I'm still doing my
Respect.
initial due diligence,
Yeah.
and I'm going to say, um, like this, if you thought Rocket Lab was risky, this is another level. This is incredibly risky. And
Yeah.
I suppose it's somewhat coincidental. We happen to be talking about two space companies, but they are really interesting companies, right? I'm not just a space guy. I invest in lots of other areas of technology and innovation. But who are ASTS and what do they do? So like if you go out with your mobile phone and if you're in like a city or something, you've usually got 5G these days in most big cities. And if you go out into the, say, the deep countryside, you might get down to like 2G, you might lose your connection. So ASTS are trying to help mobile operators fix that problem. And what they're essentially doing, to keep it real simple, is they're putting mobile cell towers, they propose putting mobile cell towers in space, in orbit. So they're not a launch provider, they're buying launch capacity from companies like SpaceX, maybe from Rocket Lab in the future. They've got a vision to put over 100 very large satellite arrays into orbit, up to 60 over the next 2 years. And then those 60 satellites working in partnership with companies like Vodafone, AT&T, Verizon. They'll work in partnership together. So if I say I'm a Vodafone user in the UK, if I say if I'm flying to Edinburgh this afternoon for the Edinburgh Festival, so I would usually lose connection if I'm on the flight. But with once Vodafone are partnered with ASTS, then I'll still have my cell phone connection, notwithstanding flight mode and getting in trouble with the air stewards. I'll still have my 5G, my 4G at least connection.
Something like Starlink, is it? Something like Starlink.
Yes. Now there's sort of controversy and there's arguments between the SpaceX Starlink community and the ASTS community. And actually, I own both. So I've got a private stake in SpaceX. And I've been having this debate with my Wall Street Wildlife podcast co-host for the last many months. But finally, I came around to the idea, and now I'm a shareholder of both. So the criticism from the ASTS community is that Starlink, Elon's talking a good game with Starlink, but actually, it's the technology of their current generation satellites really is only going to allow like text messaging and very low bandwidth connectivity, won't be able to make phone calls, won't be able to have like high data 4G, 5G connections. Whereas in theory, the design of the ASTS satellites and the way they operate in conjunction with the frequency owned by the Vodafones and the AT&Ts means that your cell phone should be able to have a 4G connection from like at sea, like a huge geographical area. And so the argument is that the technology is much better than Starlink's, although they're yet to prove it. And so I said this is really risky. Like it's a pre-revenue company. So you can't really do any financial analysis on this company. All you can look at really is like the burn rate, how much money they're spending, and how much cash they have on hand and their debt and some things like that. You can't analyze revenue in any meaningful way because they don't really have any revenue. And then you can't have a valuation multiple because there's no like denominator in the valuation. So, so it's a story investment. And there's a lot of very challenging technical hurdles for the company to overcome. So without going into too much detail, essentially their design requires them to launch like 60 of these very large satellites. These will actually be, apart from the James Webb Space Telescope, these will be the largest single things that we've ever put into orbit as a species. And they're these huge 64 square meter satellites that kind of unfold. On one side of the unfolded satellite is solar cells to capture power. And the other side are thousands and thousands of like cell tower connectivity. So essentially acting as like a cell tower in space. So they have to they have to get these things into orbit. But okay, that's mostly solved by SpaceX. They have to unfold them. They have to keep them in orbit for like an operational lifespan of maybe 6 to 7 years. And that's quite hard because low Earth orbit, you're not in a pure vacuum. There's a bit of drag. So then they have to keep these things like perfectly aligned on their inclination plane. And they have to sort of keep them up there so they only have a certain amount of propellant. And they'll use a combination of propellant and reaction wheels to try and keep the satellite where they want it to. But we haven't really proven that with something of this scale. They have to manage power, heat dissipation. There's like a
Mm.
whole load of challenges. And so this is an incredibly risky investment right now. This is almost akin to like a venture investment, not a public market
What's a
investment.
good entry point into it? What's a good entry price?
I think it depends on your view of the story again, because you can't manage against the numbers. Like if you believe the story and you believe that they are going to successfully pass these hurdles,
Mm.
this could be $100 billion plus company. Today it's a $16 billion company, so it's like definite multi-bagger potential. But this is the kind of bet in my portfolio where I think to myself, well, they're probably going to fail 9 times out of 10. But if they succeed, that success is going to outrun the failures in terms of the return. And we didn't really touch on it, but actually, the most innovative thing they've done is the business model. So they've got all these technical challenges, but the business model is really smart. So, and it de-risks the investment to some extent because what instead of say with Starlink, one of my friends has just purchased Starlink. You go directly to SpaceX or to Starlink, and you buy your antenna as a customer. So it's like B2C, but ASTS's model is B2B, business to business. So what they're doing is they're selling the capability to companies like AT&T and Vodafone, and they're saying you can now bundle this to your customers. And I would happily, I pay, I don't know, 20 or 30 pounds a month for my connection for my phone service. I'd be happy to pay another £5 or £10 a month if I had satellite connectivity across the majority of the world. So so by selling through those customers, through those huge like firms, telecommunication firms, they don't have the marketing and the cost expense and the complexity of trying to sell to me as an individual. They just have this one contract with the mobile network operator. And technologically, they also then get to use that mobile operator's frequency bandwidth. If you remember, like the frequency auctions many, many years ago, and like the governments were making, frankly, a lot of money by selling spectrum to the mobile networks. So this is quite in demand. It's quite hard to get like an agreement, the right to use a certain bit of spectrum. Well, ASTS sidestep all of that because essentially they're partnered with each of these mobile providers and they just use their spectrum in those markets.
Nice. I think so. It looks like a promising company, but then it's not for everybody. It's very clear. It's not like Meg 7 that you put in
Right.
money and forget it. It was the damn thing.
Yeah.
One or two questions before we end, Luke. Retiring on investment. Okay, it's not an easy job. It's not. It's. Let's say if I want to retire in investments and I come and look, what's your advice to me? What do you? What are the watch outs?
I, I was interviewed by the Dividend Talk podcast last week,
Okay.
which is a really great podcast in Europe. And those guys are really focused on dividend growth investing. And we had quite a big debate about this exact question because I'm almost a pure growth investor. So, like, if you have a portfolio that's really diversified and you have a lot of income, well, essentially that's how you're going to pay the bills and manage your life when you're in retirement.
Mm.
But I don't really have that in my portfolio. So the one thing I've done that's really made a big difference to my peace of mind, frankly, is having a larger cash allocation. When I say cash, I mean like cash and fixed income. So like the UK equivalent of T-bills. I've got today about 16, 17% of my portfolio in
I saw that.
cash.
Yeah, yeah.
Yep. And then I use that. So, frankly, that's enough to pay my like living expenses for more than a decade. So
Mm.
even if my portfolio literally got decimated, my lifestyle is not going to get impacted. And so it takes the emotion, quite a lot of the emotion and the fear out because like markets are quite potentially overvalued today. I'm not making any forecasts. I don't know which way things will go. If
Mm.
the Fed cuts rates, we're probably going to see like a huge run up yet again. Um, but things are expensive. It's quite hard to find a bargain. And
Yeah.
so if valuations do take a big hit, I don't want to be in a position as a retiree where I suddenly think, oh, hell, I have to go back to work now and get a salary. So it is prudent, like at this stage in life, you have to, the key lesson is know your own risk tolerance, understand like your who's dependent on you, and understand like your own emotional control, and then just build a portfolio that doesn't keep you awake at night. So for me, that was having enough cash on hand, which gives me a bit of agility in the portfolio,
Mm.
as well as the reassurance that if my stocks get decimated,
Mm.
well, that's actually a time to celebrate, not to fear, because I've got all that cash and I can start redeploying that cash at better value points.
But did you plan it out? I think that's a great answer. But did you plan a retirement out of it that, okay, at this year end, I want to retire and I would need 100,000 pounds or 50,000 pounds or 60,000 pounds to retire? Did you have that kind of planning in mind? Or is it one day you decided that's enough, man, and I probably have, good enough to.
Probably for the maybe from 2015 onwards, typically my portfolio has increased by more than my annual salary when I was
Oh,
working for the bank. So like my event, and eventually by 2020 my annual salary was just de minimis. It wasn't even relevant. So I just didn't feel I needed that. Plus if I'm clearly passionate about investing, but the other thing I'm really passionate about is skiing and snowboarding. And I took a year out of work as almost like a practice retirement in 2020. For the first time, I did 3 months of skiing, a whole season. Really, really fell in love with the sport then. I just decided I need to reorient my life so I can do this. I can be in the mountains for 3 months every year. And like investing has created such an incredible flexibility in my life to be able to follow my passions. So there wasn't, to some extent, there was like, I'm just going to kind of jump off the cliff and hope. And clearly my timing was terrible because I took a nearly 40% drawdown 6 months after retiring, but stuck with the plan. I had plenty of margin of safety. And yeah, I kind of really enjoy life now, focusing on the things I want to do.
awesome. Luke, thanks. That was a very fulfilling conversation for me, and I learned quite a bit. And thank you so much for your time. I'm sure the listeners would enjoy this too.
Fabulous. Great, great connecting with you.
Take
Thank
care.
you.